Hello, how are you all? Once again, welcome to my special EDR series, Everyday Revision. Guys, we are going to revise one topic every day, 10 to 15 minutes, max 20 minutes, depending upon the concepts in the topic. The whole idea, as I have already discussed, is to cover up the time gap between learning the topic and going for the final last day revision. In between, unfortunately, because of our commitments, we lose the touch with the topic and then we find it difficult to recollect on our own. Here, where I'm standing with you. Simple. Okay, there I'm there. You go through these videos, take those 10-15 minutes, quick revisionary shots, and then you start with question answers and see the difference in your performance. Right? And hence, I tell you, follow this. Please share with all your friends doing chartered accountancy or any other course where financial management knowledge is required, commercial knowledge is required. Share with them, ask them also to follow and subscribe, and let us all enjoy the benefits. Let us all grow together by spreading the knowledge. Guys, today we aim to talk about a topic known as capital structure. Before we start, no, very important points to understand. What is our ultimate aim as a finance manager? It is to maximize the wealth of the equity shareholders. Correct, people? Acha, what do we mean by wealth? We have to buy him a car, bungalow. No, 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 sir. Whatever he has invested in my business, no, in the form of shares. My task is to maximize the price of that. If he asks me that, dear finance manager, what have you done for me? I would tell him, sir, you see what price you bought the share 20 years ago and today what is the price? Skyrocketed, sir, skyrocketed. That's what. Other things remaining same. Wealth is maximum when what? EPS is maximum, guys. Market price of only those shares will increase now in long run, which have good earning capacities. Yeah. Capital structure refers to what? Combination of equity, debt, preference, anything, right? Okay. So as a finance manager, we have to select that capital structure, which leads to what? A maximization of what, people? EPS, earning per share. One more interesting fact. Remember that, people, change in capital structure doesn't affect sales, variable cost, contribution, fixed cost, and EBIT. We had taken various examples of these people, right? You remember a very funny example I had told you that I teach finances, no? So my toothpaste gets over. I go to the shop. The shopkeeper tells me, sir, buy this, buy one get one free. Sir, buy this toothbrush free. So buy this. This has clove, this has mint, this has pudina. Okay, chutney banane ka hai kya? Remember na? I had told you. No, no, no. I am a finance manager. Give me toothpaste of that company whose debt equity ratio is standard. He would say, sir, you need medical attention, sir. See, guys, jokes apart, but as a consumer, what I have to do with the capital structure of, as a consumer, I'm saying, huh? As a consumer, what I have to do with the capital structure of the company? Let them arrange the money the way they want. If I like the product and if I think that the MRP is suitable, I will buy the product. So the sales, variable cost, contribution, fixed cost, up to EBIT, guys, nothing changes because of capital structure. Any change will come only after EBIT. Very simple. So to conclude, EBIT remains the same irrespective of what? Capital structure. Okay. Concepts to be learned. Now, one thing we have already discussed, that we will select that financial plan where the EPS is maximum. So we are left with only two concepts to understand. One is indifference point and the other one is what? Financial break-even point. People, don't tell me that indifference word you have heard for the first time. Indifference is the indifferent behavior. Sometimes people do. Sometimes you to do. I tell you to do something. No, sir, we're not doing, sir. What, sir? Indifferent behavior. Here, sir, in economics, you learned. I know. You learned indifference curve. Correct? Combination of, it's a set of combination of two goods where the level of satisfaction is same. Here also, people, I'm talking about two financial plans. As a shareholder, sorry, as a shareholder, as an investor, I will buy or I will invest in that financial plan where EPS is maximum. But if you tell me that, sir, I have two financial plans, two capital structure. One is having EPS of 10, other one is also having EPS of 10, sir. Which one to select? I will tell, Arey Baba, select anyone. Both are giving me same EPS. Exactly. Indifferent. It is that level of EBIT at which EPS of two capital structure or financial plan becomes same, and therefore equity shareholder is what, people? Indifferent between given two plans. Thus, what happens, people, at indifference point? EPS 1 is equal to EPS 2. We had discussed this also. How to present EPS in an equation form. How we will do it, people? Remember, no? We start from EBIT. Hey, don't tell me to start from sales. We have already discussed what sales, variable cost, contribution, fixed cost are not affected by what? Capital structure. So we are starting from where? EBIT minus interest gives you EBT. EBT minus tax gives you EAT. EAT minus preference gives you PAESH. And PAESH divided by number of equity shares gives you EPS. Okay. So you have to reach from here to here. Na? Okay, na? ठीक है ना? From EBIT, I deduct interest. EBIT minus interest. EBT into 1 minus tax. So it will take me to the previous chapter we discussed this. Take any pre-tax value, multiply by 1 minus tax. It becomes post-tax. So EBIT minus I is giving me EBT. Into 1 minus tax is giving me EAT minus PD giving me PAESH. PAESH divided by number of equity shares. Okay. Usefulness of indifference point. People, very simple. Also for you, especially for you, it is also known as what? EBIT EPS analysis. What inference to draw? An expected EBIT is greater than indifference level. Expected EBIT more than indifference level. Then select which plan? Levered plan, the one with debt. It will give you more EPS. Acha, if expected EBIT and indifference point both are same, then select any plan because they both are giving you same EPS. Okay. And if expected EBIT is less than indifference point, people, then what to do? You have to select an unlevered plan, the one without debt. Okay. Acha, very important, people. You remember in one of the sums in classwork section, it had happened that we tried to find indifference point between three plans, plan 1, plan 2, A, B and C, A, B, B, C, A, C. And in one of the combination, we couldn't solve it further. And then what we concluded, it may happen that there can be two capital structures who may never have a indifference point. Because if the lines are going to run parallel, they will never intersect and there will be no such thing called as indifference point. Okay, one last concept. Let's talk about financial break-even point. What is financial break-even point? Break-even point is no profit, no loss. So from the viewpoint of equity shareholder, financial break-even point will be that level of EBIT at which what? EPS becomes nil. So you start from EBIT, you pay interest, you pay tax, you pay preference dividend, and PAESH is zero, people. Money over. Still okay now. Money over, PAESH is zero, means EPS is zero. So you have not earned anything, but you have not paid also anything. Now, nothing has gone out from your pockets. Thus, after deducting interest, tax, and preference dividend from EBIT, PAESH becomes nil. So EPS is also. To calculate financial break-even point, what we say, it is that level of EBIT at which EPS is nil. So we put EPS nil, so we put the formula of EPS and we solve and we get that this EBIT is equal to interest plus preference divided upon 1 minus tax. And remember, higher FBEP means what? Higher risk. Correct? We have discussed this in a classwork. Correct, people? That simply completes with the concepts of this chapter, people. That is the only concepts. Guys, I hope this is turning out to be very helpful for you all. I'm very sure within few minutes we have revised the whole concepts. Guys, nothing like this. So we are making the subject very easy. Share with your friends. Do watch this regularly. Involve everyone in this, right? Wish you all the best and see you soon in the next video. Okay, guys, do take care. Study regularly. Take care of your health also. Bye bye.